Hi folks, and welcome back to yet another 5-Minute Friday here on Meaningful Money. It's great to have you with me. Let's talk about funds today. So listener Marc with a C, he's asked questions before. He's getting quite greedy at asking these 5-Minute Friday questions, but you know what? Keep them coming, Marc. Marc wants some clarification on the difference between OEICs and investment trusts. OEICs? What's that? Little sort of mucky-faced urchin from Victorian London? No, it stands for Open-Ended Investment Company, and it's just a kind of fund. So let's clarify that further. Stick 5 minutes in the clock down here in the bottom left. Say a quick thank you to my buddies at 7 Investment Management for continuing to sponsor the show, and let's crack on. So, as I say, OEICs and investment trusts are just types of fund. You may also come across unit trusts, which behave similarly to OEICs. Let's say you want to invest in shares. You think that shares is a good asset class in which to invest your money. Most of us who do that invest using a fund. Why? Because it gives us greater buying power and it gives us greater spread. Buying power? Well, in a fund, you are pooling your money with other investors in the fund. So combined, you have a much greater pot of money to invest with than you would if you were investing on your own. And it gives us greater spread because we can use that larger amount of money to buy more shares in more companies across more countries in the world, and having that greater spread reduces our risk. So what's the difference between OEICs, open-ended investment companies, and investment trusts? That's what Marc really wants to know. And the key difference is that OEICs are open-ended and investment trusts are closed-ended. Well, thanks very much, Pete. That's incredibly helpful. Don't worry, I'm going to clarify right now. An OEIC is open-ended. That's what the OE stands for in OEIC. And what that means is that if more people want to invest in that fund, more shares in the fund are created by the fund manager. If people want to sell the shares in the fund, they can either find people to sell them to, so find buyers, or their shares are destroyed by the fund manager. And that means the number of shares available in the OEIC fund is constantly changing, depending on the number of people wanting to buy and sell in or out of the fund. Now, by contrast, investment trusts are closed-ended, and that means that there is a fixed, finite number of shares in existence. That means that if you want to buy into an investment trust, you need to find somebody willing to sell. You do that on the stock market. You don't have to sort of, ring people at random. But you need to find somebody willing to sell. And conversely, if you want to sell out, you have to find somebody willing to buy your shares. So that makes investment trusts potentially less liquid. That is, less easy to sell out of. Think about it. If an investment trust is doing badly and lots of people want to sell out of it, well, it may be difficult to find buyers for your shares, and that might depress the share price even further. On that basis, it's fair to say that investment trusts are arguably a little bit more risky in principle than OEICs. There are two other factors which are unique to investment trusts. The first thing is that shares in an investment trust are traded on the stock market. The shares have an intrinsic value called the net asset value, and that's based on the total value of the underlying assets that the fund holds. But overlaid on top of that is market sentiment. So if the market thinks that the fund isn't doing very well and perhaps doesn't have a great future ahead, then more people will want to sell out than will want to buy, and that will depress the price, possibly even lower than the net asset value, and that's called trading at a discount. You can buy the shares for less than they would actually be worth if the whole thing was unwound and all the underlying investments were sold. Conversely, if the market thinks the fund is going to do well and the outlook is positive, then more people will want to buy those shares. That will push the share price up, and the price could end up being higher than the net asset value. And we call that trading at a premium. So it's great if you can buy at a discount and you think the outlook is positive and that actually pans out, you can make more money that way. But the reverse is also true. So the fact that investment trust shares can trade at a premium or a discount is arguably an added risk factor. One other thing that's unique to investment trusts is that they can borrow to invest. We call that gearing. So if the investment trust manager sees an investment opportunity that they want to take advantage of, they can borrow money to buy a bigger slice of that opportunity. Of course, this definitely adds risk because the borrowed money has to be paid back no matter how well the opportunity ends up panning out. If it does badly, then not only has the investment trust lost money, it's lost other people's money, the money that it has borrowed. So again, an added risk factor. Now that might all sound that I'm pretty negative on investment trusts, and that's not the case. They definitely have their place. Now, because investment trust shares are traded, you may pay dealing fees if you hold them on a platform, which you wouldn't when it comes to OEIC shares. So it's just something to be aware of. What are the implications of owning an investment trust versus an OEIC in terms of costs and added risks? So they have their place. Just like anything with investing, go in with your eyes open, understand what you're getting yourself into, and accept the consequences of your decisions. My view is that for most ordinary investors, investment trusts will be a satellite holding, a little bit around the side, around the core of passive multi-asset tracker funds. Something, let's face it, I talk about a lot here. Okay, Mark, hope that is helpful and clarifies things for you. Thank you so much for your question. Do keep them coming. I don't care how many you send in, I'll keep answering them. Thank you so much for watching. I'll see you next Friday for another 5 Minute Friday here on Meaningful Money. Have a great weekend.